Okay, as expected, things are getting pretty interesting this week, and the narrative is definitely shifting back towards the macro, as it should. Number one, because Nvidia has failed to spur a broad rally now for a week going. Really, since we faded on Nvidia's earnings last week, the tone has shifted. Now with bonds selling off again, the tone has shifted even more. So one impact that I see is that the dollar just looks like it still is too soft. Even after today's rally, the gap that I've been watching between yields and the dollar looks like it's going to close with the dollar firming up. This is a pretty tough call right now, but I think the yellow light that I've had on the dollar does need to go green even before the bond light goes red. So I'm keeping bonds yellow here because there are basically 2 out of 3 macro regimes that could happen. One is a decent amount of growth, which is yield positive. The other is recession and slowdown style stuff, which is maybe definitely yield negative. And then stagflation, still not sure about that, but it looks like 2 out of 3 of those scenarios is probably dollar higher, actually, especially if stocks get into a weaker portion of earnings here with companies in the cloud sector disappointing. The dollar generally catches that bid as risk off. So the potential for stocks to have a valuation reset here also helps the dollar bull case. But really the first point is actually centered on bonds. The sell-off that we've seen in treasuries has been important, but the dollar held on in a very key way. Basically, we had still continuing higher lows. Dollar held the uptrend when it looked like maybe it was going to break down. There's a possibility here still that some of the global central bank expectations will end up being a little bit more hawkish than what's currently being priced in, and that could be limiting the dollar's rise. But mostly, I think still your backdrop is just fairly unbeatable for the dollar. We already got the move in the 10-year here, but the reason why I'm not making this into a red light for bonds, green light for yield is because you still have a lot of trading up here between 4.6 and 4.7 that the 10-year yield needs to get through. That's why I'm not putting the red line on bonds yet. I want to see what happens at that yield resistance. But whereas the dollar is concerned, I think that the chart generally has kind of more of that momentum that still prevents downside. So the greenback too also, keep in mind, we moved pretty quickly down here, which means that the upside to the dollar could be pretty swift. We're already in the middle of these 2 big candles from March, so the dollar seems like it can move pretty quickly if either stocks come off or if rates keep moving higher. The other thing to keep in mind is just our data have been beating expectations, and that's why you've got yields trending upward as well. It all looks like it's pointing towards inflation still as a major theme. By the way, the economic surprise index has bounced back a little bit too, and that helps as well. When you've got a couple bad weeks, really a bad couple months for economic data, kind of turning the other way here, that's reassuring generally, but it also puts the focus back on inflation. Check out the economic surprise. We might even be able to go above the flat line again here. Now, you may not want that to happen with inflation on Friday, but it's kind of looking that way, frankly. You still have a healthy enough consumer. Even though things have softened a bit on the margin in the economy, people are still spending. That's going to keep some of the inflation metrics bid. If inflation is warm, or if GDP is warm, the dollar looks set to catch up to yields to the upside, and if stocks come off it all, the dollar also probably catches a bid there too. So it still just looks like the greenback is unbeatable.